Anatomy of a real pump and dump. Disclaimer, this is not investment advice of any kind. You're on your own. These types of stocks are very risky. You could easily lose all your money. This data is from an actual SEC complaint alleging a $33 million manipulation of 8 small U.S. companies. Microcap companies are easier to manipulate because they have smaller public float. The defendants merged Chinese companies into U.S. public shell companies in reverse mergers. The companies changed name and conducted a reverse split. Large blocks of unrestricted shares were issued at little or no cost to nominees whose names were being used to disguise the defendants' ownership. This enabled the defendants to control the entire float of the issuer's stock. At first, there was little or no trading volume in the stock, which often traded at prices below $1. The defendants, corporate insiders, or others at their direction opened brokerage accounts in the names of straw parties or nominees and deposited the public company's stock. Next, the defendants coordinated the launch of spam email campaigns touting these low-priced stocks. These spam attacks corresponded with press release campaigns purporting to announce positive, newsworthy events that hyped the public company's business. The spam emails contained false and misleading information and baseless price projections. Some of the emails contained false and misleading language concerning purported acquisitions. These spam emails were intended to pump or increase the prices of the securities and/or create demand for the securities. These campaigns often created a short-term spike in volume and price. Along with or shortly after the spam email campaigns, the defendants sold all the stock in these public companies. Under instructions from the defendants, the corporate insiders or others working on their behalf, one of the defendants immediately wired out the entire proceeds of those sales to foreign bank accounts in the names of those nominees. The proceeds were used to pay the defendants and the spammers. In some instances, part of the proceeds were also sent back to the issuer or corporate insiders who had concealed their beneficial ownership and trading in their respective issuers' securities. We now look at one of these stocks. To start, the company issued 30 million shares of stock to a consultant for, quote, business restructuring services, unquote. This increased the outstanding common stock to 31,162,902 shares, and the 30 million shares were 96% of the outstanding common stock. Using an invalid SEC filing for 6 million shares, the defendants were to sell 5,780,000 shares in the pump and dump. The stock was then relisted on the over-the-counter bulletin board. The company filed a 10-Q with the SEC showing $53 in cash and a negative net worth of $10,000. A spam email campaign was coordinated with a press release campaign. The spam emails falsely said that the company was to acquire a $75 million project, that it was in partnership with a multi-million-dollar developer, a potential agreement with a brake manufacturer, and it had the prospect of building an auto exhibition center. The spam email often predicted the news in the press releases. Quote, get in on X before the news hits. The company coordinated 13 press releases with the spam email. For 90 days before the spam, the stock traded sporadically at prices from 0.00013 to 0.22 cents to 22 cents, volume ranging from 0 to 47,000 shares. Most of the trading volume was by the defendants to create the appearance of trading activity in the stock. In the 2 weeks leading up to the spam email, the stock only traded 12,000 shares on 2 trading days at 11 and 12 cents. Here's the chart. There were 3 stages in the trading. First, up until the spam campaign starts, the defendants created some trading in the market that pushed the stock from virtually nothing to 20 cents on light volume. The stock trades as high as 30 cents. Volume, 13,000 and change. As the spam campaign starts, the stock spikes to 69 cents. Volume is over 2 million. As the spam continues, volume is over 5 million and the price closes at 20 cents. You can see this on the chart. Assuming that most of the sell volume was from the defendants, their take during this week was probably over $1 million. After the spam ends, the stock still trades at about 10 cents per share, hundreds of thousands of shares per day. By the next year, the price is down to 3 cents, and the volume is only tens of thousands of shares per day. This follows the pattern I describe in my books: accumulation, markup, and distribution. The stock was accumulated by the insiders at low prices when they watered the stock and in their early purchases in the market. When the spam started, the stock was marked up and then distributed. What caused the great spike and the great public enthusiasm for this stock? Seeing the great news, speculators buy, hoping that there is a greater fool to take them out at higher prices. Some of these buyers are day traders who do not care how high the stock is. They only care that the stock goes higher. The stock rose to a market value of some $15 million or more at its peak, when in actual fact the company only had a minimal or negative net worth, minimal or no revenues, and little or no cash. Anyone paying up for the stock was gambling in the future. In most of these stocks, the future rarely materializes. Buy stocks that are selling below their true value, as I describe in my book, How to Find a Home Run Stock. For more on stock trading, go to my website, investing-performance.com. And buy my book, How to Find a Home Run Stock, on Amazon.com. Subscribe here on YouTube for more free videos, and let me know what else you would like to see.